Hey everyone, welcome back to Corporate Decoder. Today, AmperCap Acquisition Company filed an 8K announcing the closing of its initial public offering, and I'm seeing a very common SPAC pattern emerge. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details how AmperCap raised a significant amount of cash through its IPO and will break down where that money is going and what promises have been made. So, on the 4th of June, AmperCap Acquisition Company, or APCU as it is known, wrapped up its initial public offering. They sold 12.5 million units and each unit went for $10. This brought in a whopping $125 million. Now, what is in these units? Each one is a package deal, one ordinary share of the company and one share. Right? This right is like a coupon that allows the holder to get a fraction of another share later on, specifically 1/10 of an ordinary share, but only if AmperCap successfully combines with another company. Think of it as a little sweetener for investors to hold on until a deal is done. This whole setup is pretty standard for what is called a Special Purpose Acquisition Company, or SPAC. These are essentially shell companies that go public to raise money with the sole purpose of finding and merging with an existing private company. AmperCap's stated goal is to target us Mexico deals, according to some news headlines. The filing itself, which is a Form 8K, announces these key events. It tells us about the agreements they entered into in connection with this IPO. One of the big ones is the underwriting agreement with EarlyBirdCapital, or EBC, who acted as the main underwriter. This is the contract that lays out how the shares were sold to the public. Then there is the share rights agreement with Continental Stock Transfer and Trust Company. This outlines the terms and conditions for those share rights we just talked about. We also see a private placement units purchase agreement with the sponsor, AmperSPAC LLC. This indicates that the sponsor, the folks who get this whole thing started, bought units in a private sale. Similar agreements were also in place with EBC and some other investors. These private sales or private placements involve selling another 512,500 units at that same $10 price point. This means about $5 million more came in from these private investors, including the sponsor. The filing also states this was done under an exemption from registration, meaning they did not have to go through the full public registration process for these specific sales. The filing also touches on leadership changes. John Salami, Luis Penacagel, and Alfredo Flores Ibarola were appointed to the company's board of directors on the 2nd of June. They've also taken on roles in the audit and compensation committees, with Mr. Salami chairing both. Standard practice, they also entered into indemnity agreements with their officers and directors. This basically means the company agrees to cover legal costs and liabilities for these individuals should any issues arise, to the extent allowed by law. To pave the way for the IPO, AmperCap also updated its governing documents. They filed an amended and restated memorandum and articles of association with the Cayman Islands Registrar of Companies. This is essentially the company's charter, defining its structure and rules, and it became effective on the 2nd of June. Now, let's talk about where the money is going, because this is crucial for SPACs. A significant chunk of the proceeds, about $126.25 million from the IPO, and those private placements was placed into a US-based trust account. Continental Stock Transfer and Trust Company is holding this money as a trustee. The remaining funds from the private placements will go into the company's working capital account to cover offering expenses. This trust account is the safety net for public investors. The money in this account is generally locked up and can only be released for specific purposes. These include the completion of AmperCap's initial business combination, which is the whole point of a SPAC. If they don't find a company to merge with within a certain time frame, typically 18 to 24 months, the money is supposed to be returned to the shareholders. In this case, the filing mentions a period of 21 months. A small portion of the interest earned on these funds can be used by the company for things like winding up expenses, but the bulk of it is meant to be returned if no deal happens. The company also put out press releases to announce the IPO pricing on the 2nd of June and the closing on the 4th of June. These are standard announcements to inform the public about these significant events. Finally, the filing lists all the exhibits. These are the actual documents like the underwriting agreement, the trust agreement, the registration rights agreement, and the various purchase agreements. They are all incorporated by reference, meaning they are considered part of this filing even though they are separate documents. This filing from AmperCap Acquisition Company is a textbook example of a SPAC IPO. They've raised significant capital, set up the trust account structure to protect investors, and outlined the key agreements. The success of AmperCap now hinges entirely on their ability to find a suitable target company and complete a business combination within the specified timeframe. Based on the historical performance of many SPACs, the real test will be in the execution of that merger. Many SPACs see their share prices decline significantly after the initial IPO, and a successful merger is key to reversing that trend. The risk for investors is always that the SPAC either fails to find a deal or merges with a company that doesn't perform well post-merger. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this breakdown helpful, please like this video and subscribe for more. Join our Discord community via the link in the description.